Good morning.
Awesome. Yeah, good to see you guys. Another edition of It's in the Charts. Let's do this.
Let's go. All right, here we go.
What do you have for us?
I've got an interesting chart courtesy of our friends over at Artemis. Um, Here we go. So this chart is one of the topic du jours in crypto, which is talking about Ethereum and why is Ethereum price not going up. And there's a lot of takes on this, including the age-old L2s are extracting from L1, fees are going down, and the scaling is not accruing value to Ethereum. So I wanted to put a couple of numbers up here, and because I think it's a little bit ironic. So, and I wanted to put a slightly different spin on this. So just to go through the chart, so I'll go just in this order for legends. So what we have here is a 1-year chart. So it starts in March 2024, ends in March 2025, so just 1 year. The yellow line is fees. And you can see that in March, March of 2025, we ended with $22 million of monthly fees. I will note that this is, one of the lowest that we have seen over, if not actually the lowest that we have seen over the last, I don't even know how many years, like a lot of years. Compared to a year ago, this was 606 million. So down significantly. And you can see the numbers up here too, right? It's down 96%. Ironically, some of the things that we've always been talking about, which is how can we get good economic activity in Ethereum or on any blockchain to go up? And one of these things is stablecoin volume. And you can see that stablecoin volumes actually went up 33% in the same time period. So we had, and this is just peer-to-peer stablecoin volume, right? So literally wallet to wallet. So we had $213 billion of peer-to-peer stablecoin transfer volume in March of 2024. We ended March of 2025 with 283 billion. So up 33% in that year. The last metric I'll throw at you is TVL. It's up slightly. It's up 8.5% from 49 billion to 53 billion. So, and then obviously the market cap chart, we are down 35%. So March of 2025, we're at 267 billion for Ethereum. March of 2024, we are at 413 billion. So in summary, what this is telling us is fees are down massively. Stablecoin transfer volumes are up. TVL is slightly up. We can call it flat if we want to, despite the fact that market cap and price have gone down by 35%, right? So, maybe on a constant currency basis, if you could call it that, TVL is actually up. So I wanted to throw this at you because I think it's actually really ironic, and I want us to talk a little bit about what's actually happening here. So we're getting more good economic activity on Ethereum, yet fees are going down and market cap is going down. So this doesn't even have anything to do with L2s. Like that's a separate thing. This is just on Ethereum L1, which is actually stablecoin volumes are up and prices are going down. And I have this fear, which is that actually the good economic activity that we are seeing is the economic activity that we want for the long term. But in the short term, it's actually valued at a much lower multiple because it doesn't have as much mimetic value. There's no urgency, so you don't pay priority fees. And so all of the kind of mimetic spiraling up that we used to have with speculation no longer applies. And so do we need to create a new valuation standard for Ethereum that is more set up for the long term? So I'll pause here. I would love to hear your guys' reaction to this.
Yeah, the thing that my mind goes to is clearly there's a decoupling from these two metrics to fees. And if you try and parse together where the majority of fees come from, it has to come from top of block speculation. Like, we know that Uniswap is one of the larger protocols for fees, and that's because there's an arbitrage opportunity between centralized exchanges. Also, if you rewind to, I think when Ethereum had its largest fees was when everyone was trying to buy NFTs. So there's like a rush, or there's a scarcity to being the first in transactions in a block. To your point, stablecoins don't really have that property. I'd love to see what DEX volumes look like on this chart. I have to suspect they're, I would guess that they're down compared to the rest, but maybe not. I think that would be a pretty good mapping.
It's always scary to do live changes. Let's try. Let's try.
Good luck. Live demo. There you go.
Pretty good. Okay, yeah. So it's like, is it mostly up actually, or is it say the down? I can't.
Down, like down 24%, right? So you could see this blue line here. It's down 24%.
So that actually maps closer to the price than fees.
Sure.
But I would have expected that. That would map closer to fees. Interestingly enough, if my theory holds.
Yeah. And the DEX volumes also, I think we'd have to break down into what's, stablecoin pairs versus what types of swaps are we doing. And that will also probably determine the type of priority and what people would pay to be included.
Yeah, I'd agree. I think historically it's like USDC, USDT, and then ETH to stables are the primary drivers of volume on Uniswap. And if ETH has been relatively flat to down, then it would make sense that there's not too much urgency to have a lot of fees prescribed to those transactions. And if all the L2s are taking some of the more speculative meme coin activity, then maybe fees actually drive to that layer versus on L1.
What this reminds me of is if you look at Amazon's stock price chart from 1999 to today, I might get some of these numbers wrong, but from memory, I think in 1999 or right around there before the bubble burst, they were, I think it was like $4.20, something like that. And it took about 10 years for them to recover back to that price. And obviously today, Amazon is a lot more valuable than that. But I think the question is, what type of chart will this look like going forward 10 years for, and I think this is not just Ethereum. I think this is for a lot of on-chain activity. We've been striving and yearning for activity that also feels more fundamental and activity that feels more long-lasting. And I think in the long term, we would all agree that this type of activity is very welcome. And I think the question is the short term and medium term also going to have speculation or other kind of more exciting, get your blood pumping type of activity alongside it? Because otherwise, I think, we might end up seeing a chart that looks similar to the chart that we have for Amazon. And we might be entering a period of maturation, which can feel sideways, but in reality, over the long term is actually a very good thing.
Yeah, it reminds me, a couple of weeks ago, we went through Coinbase's earnings and looked at the charts for the transaction-based revenue and then sort of more service-based revenue. It kind of feels like Ethereum has done too good of a job diversifying away from transaction and speculative revenue to, maybe more foundational longer-term revenue, but at a cost of not actually paying attention to the speculative activity, which is kind of ironic. So this is a good one.
Let me just say that trading sideways is a little bit of a euphemism as far as these graphs go. So with that, what's a great one, Chris? Breck, what do you have for us?
We're going to talk about Bitcoin, which is something that we haven't really talked about in a while. Can everyone see the chart?
We can.
Okay. So this is more of a map than it is a chart. I think someone was trying to create a subway-like representation of all the Bitcoin forks. And honestly, it's a little messy, so apologies. But I wanted to talk about something that I haven't seen in like 5 years, which is someone actually coming for the king. meaning someone trying to displace or compete with Bitcoin. I think there is an assumption that Bitcoin has won this digital gold value proposition. But that wasn't always the case. If you go back to the mid 2010s and even up to 2020, there were a ton of forks of Bitcoin. There were people that forked the code and tried to launch whole new chains, things like Dash, things like Litecoin, things like the original meme coin, Dogecoin. And then there were actually more explicit new chains that were launched as a new coin off the existing chain. So things like Bitcoin Cash, things like Bitcoin Gold, things like Bitcoin SV, things like eCash, where they actually split the chain and maybe change one of the few parameters of Bitcoin. So I think like larger blocks or changing the proof of work hashing function, to name a couple of different attempts. But there hasn't been too many of these things since like 2020. What we've seen instead is a bunch of extensions of Bitcoin. So we've seen things that look and feel like L2s, like block stacks, like the Lightning Network, and now more explicitly, like literally Bitcoin L2s. And so I don't know. The question that I have for you guys is Bitcoin actually ripe for a fork? Because no one's doing it, is this actually the time? And are there levers to pull to actually create a better or new Bitcoin, or is it too late and Bitcoin's the king, and any attempt at doing this is actually like feeble and kind of a waste of time?
Here's Breck getting us canceled. The Bitcoin army coming for us immediately. You shall not question the creed. Okay, so I think the way that I would start that is we've been talking a little bit about this, but there's always technological changes that force change. I think I've used in the past this analogy of cryptocurrencies as programming languages, and there's two reasons why new programming languages end up emerging. First one is there's a technological improvement. In the case of Rust, there's not just type safety, memory safety, there's also thread safety and just a different type of language, better packages, what have you. So there's technological changes that then make a new language come to play, a new blockchain come to play too. And there's obviously just trends, say how Ruby became popular because of Ruby on Rails, and how Python latched on to AI and now becomes very popular, and now there's new AI languages that are specific to this. So that's actually an interesting one to think through. So to say that, I think there will always be new technological trends that will be able to disrupt even the largest of the blockchains. I don't think we should ever think that something is completely over. And the biggest one is obviously quantum. The Bitcoin is obviously very vulnerable to quantum, like are most, if not all, of the other blockchains. The estimates are 36% of the addresses of Bitcoin all the way to 50% may be vulnerable because the public key is actually known, is not hidden behind some hashing function. And so Shor's algorithm, if comes to fruition soon, can actually factor them easily. And so that would be obviously the moment in the most obvious technology that is coming that would actually shake the grounds on top of which we've created our blockchains and would allow disruption. If that means that Bitcoin will actually lose its dominance or not, who knows? But that would be one of them that is pretty clear.
Yeah, I agree. Like in many ways, Bitcoin is like anti-fragile to the classical cost curve coming down, right? Like there were many attempts to make Bitcoin less costly, and that has obviously failed. Like the gold narrative has stuck. So anyone that's trying to make bigger blocks or faster blocks, I feel like it's a fool's game. But to your point, yeah, like quantum is an existential threat, and it's unclear if Bitcoin's going to move fast enough to be able to actually like support some of these things. We've actually had some folks pitch quantum like Bitcoin things lately. So I hear that.
On the other hand, go ahead, Chris.
Go ahead, Diogo.
No, go ahead.
Finish your thought.
I was gonna say that, to be fair, I don't know with what percentage of belief I believed in this, but when Ethereum came along and there was an actual smart contract platform that was usable, it was so easy, and so many people made the argument that why would you ever choose a platform that is not programmable and versus a platform that is programmable? And people were waiting for the flippening with bated breath. That clearly hasn't happened vis-a-vis our prior chart that Chris brought. And so the reality, though, is that instinctively there's a lot of staying power, there's a lot of network effects, there's a lot of brand effects, there's a lot of liquidity effects, there's a lot of moats, there's a lot of stuff clearly that are they're just very hard to. Bitcoin is Lindy, and these things are Lindy. I think quantum does feel like it's not an addition; it is a disruption of the main value proposition, pun very much intended, right? Store of value proposition.
Yep.
And so that might be different. I can't see other technologies, but the smart contract platforms were one, of course, like the move to faster bandwidth, lower latency, blocks that actually allow more transactions. And so actual more payments use case. There is a view still that Bitcoin is store of value, and store of value may not have as much longevity as an actual peer-to-peer payment system. That is decentralized, and that's not what Bitcoin is. And so maybe that is actually the thing that ends up killing the king.
Yeah. I agree with you, Diogo. I think the technology aspect of this has to be so existential. Otherwise, it's unclear that it will actually force any change. But I think the simple mental model for me in understanding Bitcoin at this point is actually not even as a technology, but Bitcoin is really a culture. Some people call it a religion. It's a belief, actually more than anything. And to your original question, Breck, of forks and changes to Bitcoin, I think it's hard to fork at this point, unless you have some existential technological change like quantum. And the reason I think it's hard to fork is because literally Bitcoin is at this point a belief. And so forking a belief is much, much harder than forking a technology. It's all social. And it has to be on the order of, like Protestants forking away from, Catholicism. It has
I don't
to
know.
be.
I don't know, Chris. I mean, I'm not an expert in theology, but there's a lot of freaking different religions that are all based on the same fundamental thing. So
It has to be quite fundamental. I don't, because a lot of the forks that we see are not a fork of belief. It's a fork of technology. And I think that misses the point. I think if you're going to fork it, you have to fork the belief in some way. Like something about the belief has to change, I think. Um,
can I
and
actually
so,
give you
yeah,
one of the things about as humans go forward, and this is a huge tangent, but as humans go forward and we become more bionic and we start replacing, first we have phones, then the phones are inside of our brains, and then we have like these, well, at some point you're no longer human, you're something else. I think the same thing might happen for Bitcoin. How many modifications will there actually need to be for this to be quantum safe? Is it just a small modification, which people still feel like it's the real Bitcoin? Or do we have to do such heavy surgery? And for example, the most obvious thing is what happened to Satoshi's coins. And that is already a religious fork. That is literally of the scale of, is Jesus a prophet or is Jesus the son of God? That's
100%.
clear fork.
I think I agree that like that's not technologically, that's not technology. That's just a belief, right? So I would agree with that.
Even with your framework, though, like Bitcoin Cash was a belief that Bitcoin should be cash, not gold, right? So it was manifested in a technological change to increase the blocks, but it was philosophical. Bitcoin Gold was proof of work. The hash is actually like it accrues value to the ASICs, and so we need to have Equihash, which is the ASIC resistant, and so it's more, democratized. Bitcoin SV was Craig Wright, who claimed to be Satoshi trying to make a play on the religion. And so I think some of them have actually felt more social in nature. Quantum is the one that feels more technological, right?
And so does
like,
Ethereum, by the way. Ethereum is a Bitcoin fork to a certain extent. At least, theologically is a Bitcoin fork. It was a proof of work chain that
We're definitely getting canceled now.
yeah, for sure.
There's no question. It's a rite of passage. It wouldn't have. There's a remix, Diogo. It's a remix.
No, it's going to be fascinating. And
but isn't it interesting that no one's even tried? Like, it was like so in vogue to try and start your own Bitcoin fork from 2017 to 2020, and we literally haven't even seen an attempt in 5 years. Like, proof of work is like a dirty word now, and now we see the technologists are trying to build new like technology solutions, but there's a lack of cultural pressure, I think, to go against Bitcoin, and I find that really interesting.
well, maybe 2025 is the year. There's maybe that's what's going to happen. So we'll keep track of this one and kind of like look back. That's going to be an amazing one.
This is a good.
Okay, yeah, this is a good one.
Stuff sharing.
Even though it's on a chart, okay.
I know it's a subway map. It's just I was trying to find something that had dates that should some sort of like longitude is, yeah, it's hard.
That is amazing. Okay, cool. So this is what I brought you. I brought you two charts, as usually I like to cheat. So this is the first one. So what you're looking at is a chart from 2000. So since 1996 to around 2024 of there's two lines. One is light blue, the other one is dark blue, and one of them is passive and active investments as a percentage of total equity of assets in AUM. So it comes from a global research group into passive and active share of total equity funds AUM since 1996. And as you can see, it starts out in before 2000. It starts out at passive investments are 10% or under, and now they crossed around 2023. Active investments, they are now 54% of total equity assets, and active equity assets were over 80%. They were almost 100% of all of the AUM, and now they're actually 46%. And so basically, you've seen an inversion, a flippening has happened between passive and active investments as a percentage of total AUM. So this is the general gist of ETFs and passive investments in this narrative that has been very old of what happens to the market when this actually happens and when this flippening happens. So this is not the graph that I actually want to share. This is the general gist and the directionality in which people have in their minds of what's going to happen. The graph that I thought was more interesting kind of goes into a little bit further detail, and it is this one. Okay. So here is sort of a similar, it is a stacked bar chart versus an actual graph. And it has the share of total trading on the left, on the y-axis, and it's two bars. One is 1995, one is 2022. So it's comparing the composition of trading between 1995 and 2002. So roughly the same timelines. What you can see is, roughly the same type of behavior. Obviously, there's more detail here, so it doesn't really match the 46, 54. But you can see that in 1995, 80% of trading was active management, and 10% was speculative trading, and 2% was single stock derivatives, and then 8% was other. And now in 2022, we had 5% of other, 5% single stock derivatives, 8% passive index derivatives, 20% passive direct trading, 36% passive market making, 17% speculative trading, and now only 10% is active management. So active management goes from 995 to 80% to 2022 at 10%. So I want to make 3 big points, which I think are kind of fascinating and pretty interesting. The first one is there's a clear flip from fundamentals to flow, or at least there seems to be. Active investment is shrinking 8-1. And as you can see, 80% to 10%. It's a massive collapse in discretionary and research-driven trading. So this is interesting. And then at the same time, you see the passive and these mechanistic flows completely explode. If you add the passive direct, the passive market making, the derivative bars, we have well over half of all of the trading follow fixed rules or delta hedging algorithms. So that's a major change. And the reason why this is interesting is because it sort of implies that price discovery is no longer being dominated by the question of what is this business worth, and really is driven by the question, how does this weight in an index rebalancing or an ETF basket? Now that's actually the question that is sort of being answered if you look at the actual data. The second thing that I want to talk about is this passive market making. The single biggest slice in 2022 is this 36%. So what this is in dark green is algorithmic liquidity providers and high frequency traders that are earning the spread, but they're staying flat by the end. So delta neutral, and they only exist because these ETFs and index funds and the retail apps want near instant quotes, and the machines are stepping in to where humans once were doing. So there's machines trading this around ETFs. That's also a fascinating outcome. No longer active trading. These are just machines, and they're all trading the ETFs and the index funds and covering for this necessity of near instant quotes. And the third one is that speculation, and specifically speculative trading, is no longer really a sideshow and has grown not as much as everything else, but from 10% to 17%. And so that's kind of interesting from a perspective of also crypto too, but 17% now is speculative trading. So index derivatives and passive plus single stock derivatives add another 13%. And together, speculative trading and passive and index derivatives are rivaling the size of traditional equity trades. And so that's also another like pretty big kind of like impactful stat here. So this is the graph that I wanted to show you. I think it was pretty impactful when I saw it, and it left me thinking about well, what's inclusion? How does this mirror into crypto? Are similar things going to happen eventually? What do we think about the markets now that they're in this state? Obviously, this has evolved a little bit since 2022, but not significantly different.
Man, this is cool. This reminds me of crypto. Like, I think it's not the dates are different, but like, you could put 2017 crypto when there weren't really the abilities to arb between exchanges, and you didn't really have on-chain liquidity, to now 2025, where you have the ability to move funds between exchanges really, really quickly. You have the ability to market make both on-chain and on a centralized exchange. Like, I feel like a lot, this mirrors what I feel like has happened in crypto in a lot shorter and more compressed timeline. It's like the maturity of the market. I would also love to see the magnitude of total trading, because I have to imagine the like Two Sigmas, the Rentechs of the world would say that they've actually made the market larger and more efficient. And so I think that would be a cool addition to this. It's just like, how much bigger is the trading market from 1995 to 2022? This is cool.
The thing that I'm curious about is what's the correlation versus causation. So I think one theory or hypothesis is that people are lazy and they don't want to do as much active investing. It's just more convenient to put it into a wealth front or some robo advisor and see it clip a couple % here and there every single year. Obviously, there will always be people that want to actively manage their portfolios, but I'm talking about just the average person doesn't really want to do active trading, is at least my experience from the people around me. And then the second thing, though, is that I don't know the exact stat on this because I didn't prepare, but my understanding is that the majority of returns from the S&P 500, at least over the last couple of years, have come from a couple of companies. And so as a result, the active trading doesn't seem as lucrative anymore, because who cares if you're trading the 400th company in the S&P 500? Really what you should have been trading or holding are the top 7. And so I don't know what the correlation and the causation there is, because they're definitely intricately linked, right? If people might become more lazy because actually there are no returns to putting in more effort and researching the 400th company in the S&P 500. Or it could be vice versa, where you just have liquidity begets more liquidity. And then, as we all know, the markets are driven by liquidity in the short term and fundamental value in the long term. So I'd be really curious to know what the underlying drivers are here. I don't know what data we could dig up to try to tease out that correlation versus causation, but that was the immediate thing that I was thinking about.
Yeah, it's a really interesting one. And look, at some point, it's also, there's the question of when this gets small enough, are we even finding alpha? But then it's a rebalancing function or a balancing function. If nobody's searching for alpha, then alpha in theory should be getting easier to find. So somebody else will step in. But it's kind of fascinating, right? That the market is going down this way, that the majority of this is just passive and robots helping the passive investments. So that was my chart for this week.
I was going to say the other thing, though, is that I think this is active and passive as defined by the user, right? So is the user passive or the user active? And once we introduce agents into this, it's going to change the game entirely, because technically it's going to be active, but to the user, it'll be passive. And so from an actual trading activity perspective, I think we could see active go up in percentage, but to the user, it'll be actually even more passive. As in, there's going to be more active rebalancing and more active trading of the portfolio, because agents are just going to be, as the percentage of passive market making has gone up, because obviously algorithms are just much faster at recognizing and reacting to the markets than humans are. That portion is going to grow, but I don't think it'll be called passive market making anymore. I think it'll be real active rebalancing of the portfolio in a really high frequency way, and it's going to change the market once more.
Awesome, guys. That was another episode of our It's in the Charts. Thanks for participating, and
don't cancel us. We want to do another one.
Cancel us. Come at us. Come at the king.
And if you are coming at the king, please come and pitch us. We'd love to see it.
Sorry, everyone.
Yeah.